Well, we do. Leave that one for them, and then we can share this one. Right? So we can kind of go. You have yours, right? Okay.
Yeah, but then you gotta be able to give him.
Then give that to them.
Yeah, so there's only 3 mics.
Yeah.
Yeah.
So this one you gotta share you, and that one.
Right, but do we
That's
have?
for
I
them.
think we need to go on the end because
Oh,
Because
you're, yeah, 'cause he's
gotcha.
moderator.
Okay,
Yeah.
got it. Okay, so
Yeah,
we're good.
yeah,
All right, so
okay.
they get that one then. Okay.
Okay. Yeah.
The third speaker. What do you my son Anton and Bruno? What's that? I'm getting my son Anton and Bruno again.
Okay, welcome everybody to the Blockchain NYC crypto event. I'd like to welcome you to this space called Projective. And today what we're going to be doing is talking about asset-backed cryptocurrencies. We've got 2 companies here that are deeply involved in that space, and we'll be able to pull their knowledge and learn about the asset-backed crypto space, or ABCs. This event has been sponsored by a couple of different organizations. First one is Projective Space, which owns this space. This is a co-working space. And I'll have James come up in a minute to talk about this space for 2 minutes. And also it's sponsored by Sun Fund, who has graciously bought the pizza for us. And by Beast, which is a asset-backed cryptocurrency group, and we'll be talking to them today as well. Blockchain NYC is a meetup. We're focused on pure blockchain education-based content. We're expanding. We've got now about 2,000 members in the meetup. We're expanding into 11 other cities, including DC, Boston, Philly, Miami, Houston, Seattle, San Francisco, and those spaces are going to be growing fairly rapidly, and we'll be eventually in a position to own the roadshow for any organization that kind of wants to go out there and teach people stuff. So let me just get started with James. I want to talk about Projective Space. Here you go.
Thanks, Jamil. And thank you guys for, guys and girls and ladies, for coming out. It's a Friday night. I can't believe that you guys filled this room. Pretty surprising, actually. But welcome to Projective Space. We're a co-working space for startups, entrepreneurs, creatives, and we're really excited to have Blockchain NYC here and have all of you here. We really would like to be a hub for people in the crypto blockchain space. We nurture startups, we nurture innovation. We have about 115 members that work here every day, and we've been around since 2011. Many different startups like Uber, Instacart, Stripe, Indiegogo, they all launched their New York City offices at our space, and we've helped them grow. And we're just happy to have other, we look at this time as like the next wave. 2011 was a big year, and we feel like 2018 is going to be a big year, and we'd love to welcome you all to join us. So if you have any questions, I'll be here all night. Our website's projective.co. We're accepting memberships from teams of 2 all the way up to 12, and then also individuals. So if you're interested, reach out. James at projective.co.
Thank you, James. So the agenda for tonight is we're going to have a moderated panel. I'll be throwing these gentlemen some questions. They'll introduce themselves and what they do, and kind of dig into their history, and then we'll shift into discussions around ABCs and what they are, and what potential opportunities they provide in the crypto world. And then we'll probably leave about 15 minutes or 20 minutes for any questions that anybody may have. I think the pizza is going to get here about 7:30 or so, and we'll have soft drinks. And the pizza will be in the back there. If you guys need to use the bathroom is towards the back left side here, on my left, in case you need to use it. So you guys ready? So I'm going to just say your first names. So this is Bargov, this is Timmy, this is Michael, and this is Scott. And what we'll first do is maybe just go around this way. If you guys can introduce yourself, a couple of minutes about your history, your background in terms of what work you've done in the past, and then we'll just kind of come back around. I'll start off with another question.
Good evening. I'm Scott Licamele. I'm co-founder and vice president of Sun Fund, and we are a pre-ICO right now. We're developing a cryptocurrency that is asset-backed, and that's backed by renewable energy assets that we will develop and own in a portfolio. And it's also going to be backed by the revenue that's going to be generated by a blockchain-enabled platform called our producer-to-investor platform that's to promote investment in the renewable energy sector. My background is primarily in capital markets and more recently in renewable energy development. I have a long background in working in emerging equity capital markets in a variety of capacities and worked extensively in Eastern Europe for many years. So that's it about me, and I'll pass it on to my brother.
Hi, my name is Michael Licamele. I'm CEO and co-founder of Sun Fund and his brother. And we are really pleased to be here. Thanks so much. We look forward to hoping to help give you some insight into what's going on in the space. My background is primarily renewable energy development for the past 5+ years, and prior to that, primarily real estate development for the time prior to that, over a 25, 30-year career. Done a lot of small to medium-sized type work, and that's kind of where we're focused in our work. We also do a lot of work in the affordable housing area, and in particular connecting affordable housing with renewable energy to help cut costs for those types of projects and such. And look forward to being here tonight. Thanks.
Hey guys. This is a pretty amazing crowd. I'm really shocked by this. This is awesome. My name is Timmy Waba. I represent Beast Enterprises. We've been working with startups since 2015, and essentially we've been kind of, I would say, a modern consulting firm originally, working with startups to try to help them figure out how to raise capital. And throughout that journey from 2015, we saw things that we just didn't like about the venture capital scene. Some things about capital having kind of not being, unfortunately, being bordered or being kind of hoarded within certain cities and hubs, but like it didn't really relate to where innovation is. And we worked with a lot of international startups, and the issues that they faced was just access to capital. And Beast has now transitioned into seeing what's come from cryptocurrency through blockchain, an ability actually for companies to raise capital without being bound by borders, without being bound by kind of a network effect or group of investors and influence. It's really become a flatter world, and it's about globalization 2.0 in terms of innovation and emerging startups that can go and really do something that's important. And now we have an opportunity to do that with the introduction of blockchain. And so we are now developing a fund, but really a venture studio, where we can go and utilize the best aspects of what we know in the venture space to go and tap into new markets, to tap into new industries, and to really find the right kind of backing and build a sustainable company. Not a company that is just out there for that hype cycle, but a company that actually is able to raise capital, equity, however it may be done, but in a way that actually provides returns to the people that supported them initially and to the founders and protect their interests throughout that period.
Hi everyone, I'm Bhargav Kosuri. I'm a strategist at Beast, and my background includes real estate. I worked at different startups, and my associations involved marketing, product management, and operations. But since I've been here at Beast, I've been looking into a lot of capital aspects that startups need. We have helped startups raise money traditionally through venture capital. Equity crowdfunding is something that has been interesting over the past year. And obviously ICOs, because this is the new way that everyone wants to just raise money. But we feel that it's not just a way to raise money, but it's also an opportunity to solve a VC model that has not changed much in the last 40 years. So that's kind of what the fund that Beast is working on. Yeah.
Okay, great, thank you. So I'm going to start off with, let's start off with a high-level question. I think there were 2 cease and desist letters sent out, I think it was today, by the SEC to a couple of ICOs. And Michael, you mentioned to me there were about 90 subpoenas that went out this week, including subpoenas to attorneys. So WTF, what's going on? Let's break it down. We'll start with you, maybe Michael, you can tell what's going on, and maybe Timmy, you could tell us, give us a perspective. Thanks.
So I guess the first thing to say is I'm not the attorney, so I'm not going to make any judgments or announcements about those things. But essentially, the big question that's been in the industry for the past year is what are these ICOs and what are these types of entities, these tokens, utility tokens and such. And for a long time last year, which is a relatively long time, people have been running around saying, well, our token is a utility token. It has use as a utility, so therefore it's not a security. And when you're giving us money and hoping to make money from that, which essentially is the definition in part of a security, that the result is that it's just going to be utility. And a lot of those offerings are in very odd structures and overseas and in foundations, and you don't really know what the governance is and such. So if you can look on C-SPAN, last week there was a hearing in Congress, and the head of the SEC and the head of the Commodity Futures Trading Commission both got up and talked about 2 things. One is they said they did not want to get in the way of really helping the blockchain industry grow, and they didn't want to stand in the way. But on the other side of the coin, and that's what a lot of people in the industry heard, but the other piece that what was said was essentially that they felt that every ICO was essentially a securities. So if that's true, then essentially most of those that have occurred, most of those ICOs the last year, anything that's been involved in the United States is potentially at risk for some backward liability there. And so we kind of had looked at this back in the fall and said, hey, we'd like to do our ICO and be out there with our token. And we kind of made that decision right off the bat. We said, you know what, this is going in a direction where regulation is going to come in and really start to have some time. And just a side note to give you some perspective, I was at a conference in DC back in November, and I met a plaintiff's attorney whose job was to sue securities, and ICO type companies when there were problems and issues. And his one quote to me was, in 2018, I'm going to be rich. And it was because knew he was going to completely, start taking apart a lot of these offerings. So I think from a perspective of, the other piece is that from the perspective of what is a token, it could be a security, it could be a commodity, and it could be a currency. And there isn't really a regulatory structure right now which accounts for all 3 of those. And we're kind of talking a little bit before that we're hoping that maybe there could be that, but in the meantime you really have to pick one. And so we chose the security route, and there may be others that choose the other route, but that's kind of the where things are as of right now in the marketplace, and it's a very fluid situation.
Yeah, I'm not a lawyer. I just play on television. No, the truth is, like, WTF, the last year has been basically New Year's Eve, and today is New Year's Day. Like, sobriety is coming in, which is good. Like, we need that. We need to essentially rid some nefarious figures, which are a lot, of utilizing this as a way to raise money. I mean, you could see so many parallels between how bubbles start, Big Short, people making money off of things that don't matter. It's a beautiful thing that we need to ensure maintains it's a beautiful thing that we want to ensure that basically it is not hampered by, it is not a .com bubble. It is not something that has to go and everything looks blockchainified and there's, and you can see fads and stuff like that. We want this to exist, and we don't want the government to be in a situation where it has to go and crack down, and then doing so, crack down on the innovation of it. So for like America's leadership right now in technology could be hampered by the fact that if you want to raise, or if you want to launch an ICO in the United States, it is extremely uncertain. And that uncertainty is hurt additionally by the fact that there's so many nefarious figures out there that are trying to make a quick buck. So we find ourselves in a situation of where there are legitimate people out there that are utilizing the best and most beautiful aspects of this technology, but are also like hiding and trying to play lawyer and figuring out how they can actually do this within the United States, and they can't in some ways. They can abide by some general guidelines, but you don't know how long they'll be out there for before it morphs into something else. So the alternative is to go outside of the US. And that is where the trouble starts. Again, going to like Beast's mission, it is, innovation should have no borders. Now capital doesn't have borders. This is what blockchain has enabled us to enjoy. We're able to go and fund projects. It doesn't have to be always about something being absolutely 100% decentralized according to the philosophy of X, Y, and Z and the foundation of it. It can be utilized as a tool for many things that are really important. So I'm really happy to hear about these lawsuits that are happening. I can go down so many rabbit holes looking at some very interesting ICOs that have ridiculous people giving recommendations about the ICO and using other people's likeness and things of that nature. It's a really gross world, but this is, also, this is natural. This happens. So we're entering into a period of sobriety.
Yes, so, sorry, so let's move on to the next question. So what exactly, and this is for you, Bhargav, and this is for you, Scott, and you guys can jump in if you like, but what is an asset-backed security? I mean, literally we know what the words are saying, but what does it actually look like? What is a coin? How is it coin attached to an asset? Can you talk about a little bit? And we'll start with just give us not just a definition but an explanation.
Sure. So, I mean, we have Bitcoin. So Bitcoin's, let's say it's a currency, and it derives its value from the network. And that's about it. There is no way to value it.
Can you explain what that means, that Bitcoin derives its value from the network?
So basically, when I say Bitcoin derives its value from the network, it means that the amount of Bitcoin that's being transacted and how much of dollars or any other currency that's passing through this network, you're just basically ascribing that as a value to Bitcoin. And that's not a model that works, because if I had to take Visa instead, and Visa does like $8 trillion in transactions every year. And it will be like me saying that Visa's market cap should be $8.9 trillion, which isn't the case. And that's one of the reasons why there is this gap between valuing these ledger currencies and tokens that are what we're talking about, assets. So when I say asset-backed tokens, these are basically tokens that are in a way pegged to the underlying asset. And this could be anything. So I could probably keep the underlying asset as, let's say, real estate. I could buy an apartment in New York and probably have multiple people kind of buy in through a coin. And basically the coin would act as a mark of ownership. And that's it. It's just basically putting physical assets on the blockchain and bring transparency when needed.
And just to kind of a follow on to that, so when you look at least in terms of what we're doing and our understanding and view in terms of what is an asset-backed token, essentially what we're doing is he's absolutely right. It's the underlying value in the case of our situation, which I can speak to clearly. Essentially what it is we are a C corporation in the United States. Our tokens are being registered as securities. According to SEC guidance, the most appropriate classification is a preferred equity security. So it's kind of like a special class of preferred equity shares until the SEC perhaps comes out with further guidance on tokens as a singularly, uniquely defined security, or however they want to categorize it. So in our case, obviously the underlying assets are operating renewable energy assets that generate net operating income annually. So one might then conclude and say, okay, well, what's the upside in an asset-backed token? Because if you're simply saying we're going to raise $100 million and we're going to invest $100 million in renewable energy assets, and let's say they yield 15% a year, whatever it might be, that's kind of your upside, right? Which is not really the way most cryptocurrency traders are looking at this market. So what we're also doing is we're essentially creating a token that's a preferred equity security that does not pay a dividend, where the tax-shielded retained earnings are reinvested into new assets, new projects, because in addition to investing in assets, in our case, we're actually developing a blockchain-based producer-to-investor platform, which is going to disintermediate traditional conduits of financing, such as private equity funds that, say, for example, have a rigorous due diligence process and invest in renewable energy assets. We're basically using blockchain technology to disintermediate kind of the private equity layer, as I like to call it, from the investment process and allow individual retail or institutional investors to buy and sell assets on the platform for a very low transaction fee. So we're essentially kind of disintermediating and covering and reducing due diligence costs and things like that with the technologies that we're developing.
Yeah, just to give a few examples of some other asset-backed currency. We're doing renewable energy. You mentioned real estate. Other ones that we've seen are, for example, intellectual property, where people have patents and people want to license those, and so that's tokenizing. There's a group tokenizing that type of asset. Also, music rights. Apparently, we tried to get a song somehow to some music rights for which we found to be almost an impossible task to try and get done. But so if that can be tokenized, so it's a very fluid or liquid market, that's allows those rights available. So there are numerous areas where splitting up tokenizing assets and bringing some liquidity there can really bring some advantage there.
Yeah, I'm sorry, just one final thing. So yeah, that was the other main point, is the liquidity premium. So if you have an asset that's a liquid, like real estate or renewable energy asset, you're going to add the liquidity premium that you get from tokenization and basically allowing that asset to either be fractionally or fully traded in a more efficient manner will give you a 20 to 30% liquidity premium. So by tokenizing assets, it's an accretive process in and of itself. It's adding value to the asset.
Maybe can you walk me through an actual cash flow scenario, or the process of associating a token to an asset, in detail? Like, what does that look like? How do you even do that? How do you track the asset? How do you associate a token, which is something potentially fungible, to an asset that might not be fungible? Or are you pooling things together and you have a pool of tokens that represent that pool? How does that work? Can you, Timmy, give me how does that all work? Because I'm trying to make the connection between the two. I do know how it works, by the way. I'm just being the devil's advocate here. Can you explain that?
So for instance, let's take the case of us, where we are basically trying to tokenize an asset, and in this case, the assets are just startups, because we are doing a VC fund, a tokenized VC fund. So what that would mean is we are basically going to start valuing startups in the portfolio and tie all of this together and kind of peg it to a net asset value.
Can you explain what that means? I mean, I know what peg means, but realistically, how does that? Is that a contract? What is that? Like, how do you associate two entities? Either you do it legally or you do it programmatically. How does that look like?
So you could do it programmatically if all the investments are in Ether. I mean, let's say we are working on the Ethereum blockchain, and that's how we're going about with this. And if all my investments are in Ether, then I can program that, and in the Ether world, it would enforce itself. So if I invest $1 million worth of Ether in a venture, and I mean the price of that token goes up, then it can directly be built back into the net asset value automatically. But the tricky part is when you're investing in non-blockchain, or even for that matter, if you're investing in something that's outside of the Ethereum blockchain, then it becomes difficult to actually do that.
Can you give me an example? Like, what is an example of that, the words?
So let's take, for an instance, I have cash of 2 million that I can invest, and 1 million of that I'm putting it into, let's say, a company that's issuing an ERC standard token, and I'm putting the other million in like a traditional internet startup that's building like a chat application. So this entity, the second entity, is not on the blockchain. It's an internet company that's going to be valued based on how many users it has, paying customers and revenues and all of that. But on the other hand, I'm not, in the second case, I'm buying equity in the company. So I would have to value it according to how equity works. And in the former case, because it's already in the Ethereum system and I'm investing through tokens, the value of the tokens when it goes up and down can actually tie back into the NAV. So it's easy if I put all of my money in Ethereum because that would be very transparent. But the other tricky part is you don't want to do that sometimes purely because you want to hedge. You want to probably have a portfolio where you're focusing on blockchain companies and off non-blockchain companies as well, which we are doing here. So that changes, and because once you're off of the blockchain, you have a lot of self-governance to do. And in this case, it would be audit reports from external parties. It could also be a case of quarterly disclosures of how much the value of these entities has gone up. So things like that.
So like a weird scenario, if I have a token that represents a piece of property, and that token gets stuck in a wallet, is that property like untouchable now? Like, what happens?
So exactly, that's the challenge, right? So you have to kind of it'll be a case of like you don't have any rights on that property because everything is tied to the token. So unless there are some mechanisms where you're able to identify who owns the wallet, and this is where like the anonymity factor is not good. Sometimes actually people knowing your identity can be good because then you can understand who owns that wallet, and you can probably compensate them in a way by sending another token, replacing the token, or doing something to mitigate that situation.
I think just one of the advantages of an asset-backed token is the fact that there is transparency and it's programmatic, so that there's conditions in place through a smart contract that enables you to see more into a company. And you can take that very far. But it sounds like that's not so great, but if you look at the current model right now, a private company is a private company, and they can say whatever they want, really. When it comes to their own governance, that's difficulty. So a beautiful thing, I think, in multiple industries through asset-backed tokens is that you can have this transparency about the market, about how this, say, commodity or real estate is performing, and be able to actually trust that because there is no middleman. There is no one there that can tamper with that information or interpret it in a I guess a more favorable way. Those are the exciting aspects, but it also does clash, of course, with this concept of anonymity. I'll never be able to say this word. Being anonymous.
Being anonymous.
Yeah.
Can you talk about? So how are you? Walk me through a cash flow, or the act of pegging. How does that look like? How are you associating it?
Sure.
How does that work? Yeah.
Sure. Just to kind of follow up on your original question, I think the answer for us is that we're approaching this legally and programmatically. So as my brother explained earlier, we're an actual preferred security token, so that there are specific rights associated with that. It's registered in our Delaware Corporation documentation. We're audited. We're required to file reports going forward.
What exactly is your asset? What is the asset?
So the asset is going to be the actual ownership in the actual renewable energy equipment, systems, contracts, and I guess just to walk through a typical example, we have, for example, a project in Rhode Island where we're doing a 1 megawatt system, and there's a contract with the utility to basically get paid to produce energy for the utility for a 20-year period. So all the revenues from that will come into the Sun Fund token ownership on the preferred security side, and so the ownership of the actual contract and the equipment will all be part of the assets that are in there. And so to use like a really extreme example of, in a liquidation, like if everyone had to say we're liquidating the token and everyone takes their money and goes home, it would essentially be sell those assets off, and that would be the equivalent of whatever that net asset value at the time would be. But our on the other side of the coin, the other assets, the main asset is going to be the ownership in the actual platform. I know there's a number of tokens out there that you may see that say, they've got this great technology, and then they've got this token, and they're not the same entity. And so the token will never benefit from any revenues generated from the technology that may come. In some cases they do, but in a lot they're completely separated. So that's essentially how we do it.
Are you creating the power in Rhode Island?
Well, we're going to have a Q&A
Yes.
portion. Yeah,
Yes.
we'll create a, yeah. So if I buy into a token, that token is somehow associated with a set of cash flows, right, that are coming out of machinery or contracts and things like that. Now that I have the token, can I, if I want to go pick up that machinery and take it, are there restrictions? Are we contractually restricted to say, hey, that's my machine, I want to move it? So what are the restrictions that you have around limiting what a token holder can or can't do, and how are you enforcing that?
So the way we structured it on a legal side is as a preferred security token holder, you have that ownership interest, so you know that if it ever were liquidated, you have that first preference. But there's no right to come in and say, I want my 1/millionth or 1/10 millionth of piece of equipment that's part of it.
And that's just to follow up. One of the main reasons for that is because when you develop renewable energy projects, they're generally done on a 20-year contract basis. So you would have what's called a power purchase agreement, typically with a utility or with some type of off-taker. So that would kind of prohibit the ability to fractionally remove parts of a project because they're contractually obligated to produce energy for a particular period of time. So the issue is that you have liquidation rights that are preferred in front of common equity holders of the company. So it's more of a protection, it's downside protection. And then again, the logic of that is that it's a non-dividend paying preferred equity share because the retained earnings that are generated from both the project revenue and the investment platform revenue that we'll be generating are all going to be reinvesting constantly. So the goal is to increase the value of the token or of the preferred token, if you will call it that.
Yeah. You have anything to say? So let's talk about. So if you're financially modeling, let's say I want to start an asset-backed crypto based off of the chairs in this place, right? How would I financially model that? What are the things I need to take into account? And this is open to anybody. What do I have to factor in? It's the valuation of the chairs is potentially volatile. The valuation of the token is potentially volatile. How do I go about figuring out if this is the right business I should get into, chaired-backed cryptocurrencies?
I would say that there's a couple dynamics. First, it's a beautiful situation because that's actually a physical product that you could see and touch and has been in existence for quite some time. That is something that is not typical currently today. That is something that is not very typical that you'd see. You actually don't see many products that have come out from most of the ICOs that have raised. They actually, for the most part, a lot of them don't have a product. So how you value something, when you're given a situation where there's an asset, it's an asset because it exists. And so you have an ability to go and actually value that. You understand actually what the time it takes to come to market, or what the cost of time for, say, legal agreements in transfers, et cetera, et cetera, et cetera, comes in. And you can then say, all right, well, now I'm going to be utilizing this instrument or having access to a whole world of capital at a different speed in a way of which everyone receives the same contract and they know exactly what they're getting into, and they know exactly what they will get out of it under certain circumstances. So to be able to model that, you're putting in those kind of intangible, those tangible aspects that have now made this process in an industry so much more efficient. And so it's really exciting in that regard. And that's, I think, a space that is sorely lacking understanding and interest.
Yeah, and another interesting thing that we are looking at with asset-backed tokens is that if you bring in the Bitcoin and Ether currencies into the whole mix, because they are volatile in nature, they can start affecting the value of the asset. So it would make sense, for instance, if like the case of the chair, it would be better to value the chair in dollar or euro or any fiat currency, because the chair, I believe, would have been purchased in that currency. And instead, valuing it with Bitcoin can actually increase volatility, because 2 days ago, the chair could have been a lot, and today it could be worth a lot less. And asset-backed tokens kind of, I mean, for me, I think they reduce that volatility, which is in a way affecting the market in not the best ways.
Okay, so let me give you an example. Let's say I have a chair and I've associated a value. I've got 50 chairs. I'm pulling it together. I'm issuing 50 coins. They're not necessarily associated with any particular chair. They're fungible. The value and those coins are issued based off of Ether. Ether's value shoots up. The value of the chairs are dropping down. What happens to my token?
Exactly the case that I mentioned. So if you exchange the chair in return for Ether, then the price of the Ether can affect the value of the chair. But if I accept dollars, then it's easier, because I'm not saying the dollar doesn't fluctuate, it does, but it's slightly I think manageable quantities. So let's say you mentioned the case of like 50 chairs. Let's say each chair was worth $10. So I can give one token, or I can create as many tokens as I want, and I can just calculate the entire value of all the chairs out here and divide it by that token. So now the token has a value, and the way this token can make money is by me leasing out this chair, renting out this chair to someone, or me actually selling a chair. So as long as I'm exchanging a chair in return for value, it should be fine.
So I think this sort of brings up the issue of the world's changing. Right now, what you described with changing values and changing between assets and currencies happens all the time, every day. It's just that we're here in the United States and we have dollars and we see dollar prices all day long, because you're not able to use a euro in the US right now to buy things. But in a world that we may envision or may see in the next few years, there may be 100 or 200 different currencies that people may accept in the United States, and those are going to be fluctuating constantly. There'll be different values between those currencies. There'll be different values on the assets that are in there, and that's just it can be a really great thing, because it's sort of liberating cash and capital and making things more accessible on a smaller basis. But it can also be a challenge, because there are a lot of changes, and you're going to have to be able to manage that change.
Just one kind of very high level comment regarding like cryptocurrencies in general. I think, this is just my personal opinion. I think what we're seeing is the era of the US dollar as the singular dominant reserve currency in the world is not because of blockchain or the evolution of cryptocurrencies, but because of other factors that I'm sure many of us understand, is coming to an end. And we're in the least case moving to a multipolar world where you will see other fiat currencies, playing a more important role with respect to their trade-weighted, relevance in the world economy, like China, other countries. So I think that when you look at the evolution of cryptocurrency, and not to get into the philosophical evolution of why it was created, et cetera, but I think there is a very valid case to make that, yes, we could see the evolution of globally adopted cryptocurrencies that are stateless, especially because of the many issues relating or surrounding sort of the U.S.-centric dominated global monetary system, which I think is in the process of coming, I wouldn't say apart, but weakening in its role. So sort of.
And so just going back to the financial model, I'm going to try to hone in on that a little bit more. I'm assuming, and I've seen some of the financials you guys had and the spreadsheets and things like that, but how are you factoring the unexpected? So this is a new space, right? Everybody's getting used to regular coins, but ABCs are a little bit of a new space that we're kind of getting into. How are you handling stress testing? How are you making sure that, hey, something funky doesn't show up with asset pricing that can tank our entire, or create a huge opportunity to come and buy, for somebody else to come and buy all the tokens and buy us all out, or things like that? Are there going to be token M&A now? What are you, how are you testing your models? And maybe if you can talk about that a little bit.
Well, I'll make it just a quick comment that it is absolutely a new space. And it's a situation of where you have to, this is the hard things about hard things, I guess, to say, and you have to provide your best judgment and reason. And that's kind of why it's an open field to come up with the best way to be able to protect, give transparency and protect people that are engaging in buying this token. I think there are multiple dynamics out there. What's important is essentially governance, and I think at this point in time, transparency is the greatest currency that you can have, because that is the one thing that this technology enables. And with that transparency about how say a portfolio of companies that you have are operating, if that is built in within this, or the architecture that you've built out in the smart contract, you are being able to provide investors with an understanding as to what's going on, but also the liquidity potential to actually say, you know what, this has been great, I'm going to go and sell my token, and that's that. That doesn't exist in the venture world. That doesn't exist at all. And the only way that you'll see money if you invest in a startup is through three scenarios. It's they IPO, they're acquired, or they go bankrupt. And that's the only way that you'll see money. And the odds are already stacked against a startup, and they're also a private company. And they're also funded by, say, a dominant kind of institutional investor, which basically has an acronym of V and C. So traditional venture capital also has to show that their fund is doing well. And their incentives in this case are to project that in a way that they can. And if things are not going well, they have about 10 years before they have to pay back the person that gave them money to go invest in that experiment.
And Timmy, just one more thing. You run the Columbia VC group, is that correct? Can you just talk about what you were doing there? Because you didn't mention that in your bio, and I think it's important for the audience to know that you're involved with a lot of VC companies. Yeah.
So so in the startup world, we've been engaged with it since 2010, and there's a huge emphasis on the entrepreneur. Schools are basically starting to utilize entrepreneurship as a way to go and seek out recruitment. Columbia was upset that Harvard would say, this startup was built in a dorm at Harvard. And so they wanted to go make a really strong entrepreneurial program, which is awesome. And Columbia's entrepreneurship program is kicking ass. But the issue is also, it's hard to understand how to invest in something. Investing is as lonely as entrepreneurship can be. You don't really know how to go and value something. You're taking someone's opinion about an investment. Conducting due diligence right now is basically looking at what other people have gone and done. And we're now entering a world where we're not really have to be subject to that. And you can actually be in a position of where you're like, you know, this company's awesome, but if they're not going to IPO and if they're not going to be acquired, but they're cash flow positive, I'm invested in them. You can get out with the hopes that, you know, the potential that startup is going to continue to grow, and maybe someday they will be in a position where that makes sense. But right now, it's in a tough spot of where if an acquisition opportunity isn't there, or if IPOing isn't something that is attractive to the startup, as an investor, you're sitting there and just waiting. And that's something that we want to fix. I hope I answered the question.
Not to like veer into like tech speak, but you know, if you there's a saying in like sort of amongst Silicon Valley investors that, you know, on the tech side, that like open source ate software, right? That's a common term that I'm sure a lot of people know. And so I would say, just to follow on regarding blockchain and investment and the role of VC, I would say open source money is eating VC. That's what we're seeing happening here. And that evolutionary process is very painful because it's volatile, and it's, as you guys were saying, it's wrought with, you know, many risk factors, and we have unregulated offerings and, you know, or rather unregistered offerings and unregulated exchanges. These are risky things, but it's an evolutionary process that I think is going to win, and I think the issues regarding governance are absolutely critical. So I just wanted to...
I mean, again, going back to a financial model for something like this, I think first thing you have to understand that startups are a risky asset. I mean, let's start off with that. Like, I think when you just look at the numbers, I think 1 out of 10 startups make it. So I would say understanding that risk is key. But the second thing is that there can be a lot of things that can go right and a lot of things that can go wrong. Because when we ran a few simulations, there were a lot of probabilities out there. But we started looking at like how these funds usually function. And we saw that it happens in a way where like you start off at an NAV of 1, which is basically that you're still at the same point. And as you make investments, you just keep going down. And as you start seeing returns, it goes back up. So that's the trajectory. And with this, what you can do is that there can be a possibility where the token could be trading at a value lower than the NAV of what you started off with. And you could see a lot of people kind of being skeptical about the whole operation and selling their position. So you could see something like that where no one wants to like trade this token. But at the same time, every time there's a liquidity event and you announce it, you could see the price going up. And sometimes you could see the price going higher than the NAV. Because let's say if after year 2, there's this huge startup that had a massive exit, and there's a lot of liquidity that we can give back to our shareholders, then you would actually see the NAV. There's a high chance of the NAV, the price of the token going higher than the NAV, because you feel that, okay, these guys already did it once, they're going to do it again, maybe. So it's something that the investor has to take a call on. Like, do I go with this, or do I sell out? So there are different possibilities. There are possibilities where like the whole thing can fail. Venture returns traditionally are in the best. I think more than 50% of the VC funds out there don't even make a 1x return. So we have to be realistic about those facts, yeah.
So just to follow up on that point, I think that's, you know, a key thing about, you know, asset-backed tokens is that essentially you're getting some essentially downside protection, as Scott had said, but then maybe you're getting not as much of a dramatic upside. And I know for a lot of, you know, we talk to a lot of people investing in cryptocurrencies, and a lot of people have, you know, there's people who are day trading, there's people who are 5-minute trading, and there's, you know, a lot of times there's that thought like, you know, I just want to be in this token or out of this token. Most of those tokens all right now have not only 0 assets, but 0 technology, 0 development. They're just out there, and people are trading because they're there. And so I think that when you think of it from your own perspective as an investment, you say, well, am I doing this? You know, am I looking at this company for for quick in and out hit, or am I hoping it's actually going to be there in 12 months, 24 months, 36 months, or these tokens? And I think that's going to be the big thing that's I think will develop over the next year or so.
Okay, and so let's get a little technical. Blockchain, what chains are ideal for ABCs? If I wanted to start an ABC, what chain is it? Hyperledger? Is it Ethereum? What are the considerations that I have to take into account in figuring out which of these chains I need to use or I should be using? Should I do a private Ethereum chain? Should I fork the Ethereum code? Should I use Quorum, which is JP Morgan's chain? Should I use Hyperledger? What's the thought process behind that if I want to kind of say, I want to securitize shares now, so what do I do?
I think there are two things to it, obviously. So one thing, you want to see what your investors are comfortable with. I mean, do they want their assets or their tokens to be on a blockchain that's not proven, that cannot scale? That's the first question.
Are you referring to Ethereum?
Yeah.
Ooh.
So that's the first question. And
We'll have a separate conversation later.
so aside from that, then even when we're just talking about Ethereum, there are like so many token standards, and some of them work well for what they're calling utility tokens, and some of them work better for asset-backed tokens. I think there are like certain standards where there are mutable tokens where you can change the contracts, smart contract conditions as you go, which I don't see would be a good thing for anyone. But I think ERC 721.
But we'll talk about smart contracts
Mhm.
and like ERC standards. Let's talk about the chain. Like what chain? I mean that's a critical decision. It can impact how you grow your business. What chain? What are the factors I need to take into account to consider what chain I should be using?
So that's one thing. Like I said, the case of whether the chain is scalable.
ERC 20 is, when you say ERC 20, that's Ethereum. That's not Hyperledger, right?
Yeah.
So.
So
yeah.
apart from that, I mean, just about chains, there are chains like, I mean, you could also do this on the Waves platform.
What's that platform?
Waves.
Waves, okay. Can you tell us about, what is that? What is that?
So Waves is another smart contract platform and has its own unique features. But again, it's also a business problem because you want to be able to have a token that's widely adopted, and everyone has an Ethereum wallet. So you would just want to make sure that you're not issuing something which, I mean, people don't have ready access to as well. So you want people to be able to actually have the token in a chain which can easily be transferred as well. Because if I have ERC 20 tokens, and if someone does not want to like trade on that chain, then it's a problem. So it's also important to identify them.
But Ethereum is everywhere, right?
Yes.
To your point. So why would you not want to use it? That's not what. I'm not clear around.
Oh, I would want to use Ethereum.
Oh, so you change your
yeah.
mind now.
I mean, we.
I mean, you were like digging
No,
Ethereum in the
sense-
beginning.
No, I was saying Ethereum has its own issues, but as of now.
So do we all. But so
Exactly.
what? Yeah.
But as of now, there's
I got
no better
issues.
alternative.
Yeah.
Yeah.
Okay. Yeah. So Michael.
Like we have to take baby steps. Honestly, but truly, everyone is just wrapping their head around blockchain. They're still kind of understanding, separating it from what cryptocurrency and what Coinbase acts to a lot of people, which is kind of a gateway drug to day trading. And for the four tokens that they list there, it's a beginning point for institutions to understand. It's like, we're in a space of, I guess I would say like maybe 2012, and it's the cloud, and everyone is trying to really figure out exactly what the cloud is. And there's a whole industry behind trying to demystify a technology that has, that is generally overvalued in the short term and undervalued in the long term. So we're in a situation where people are just starting to kind of touch and feel. It's like 1995, and you're touching and feeling the internet for the first time, and your only access to the internet is AOL, and you don't really know that browsers exist and that there's actually websites out there. You just know keywords, and right now the keywords are Coinbase Bitcoin. Sorry, AOL is Coinbase, and Bitcoin, Ethereum, Bitcoin Cash, and Litecoin is the keywords. And so it's going to take a bit. Right now, I think what's interesting about asset-backed tokens is that it provides an opportunity for institutional investors to relate to buying a token and understanding actually what this is like pegged to. I know this is deviating a little bit, but I think it's extremely important to have that kind of buy-in and understanding, because the amount of times that I have conversations with people, and rightfully it's very difficult for them to understand what the inherent value of something is when they haven't seen or touched it, or understand network effects and things of that nature. I completely understand how that is a difficult thing. So right now we're entering a situation where, because they're actual products and we're not looking at such a prototype concept, traditional ICO of like July and prior, we're in a stage where people can now really relate to a specific industry based on their domain expertise or something of that sort.
Yeah, blockchain. Which blockchain?
So I'm just gonna be really clear. We looked at this a lot, and we took a lot of time to consider this, and we're straight up gonna go with the Ethereum network for now. And
I like you, Michael.
And a couple of reasons for that. One is the main thing for us is as an asset-backed token, we have a different business model than a lot of the companies or tokens that are out there. We are not looking for a high transaction volume, super low cost environment, which a lot of places, like if you want people to use your token to buy bubble gum at the store, you need that. You need to be like a minuscule fraction of a cent. To do that. In our case, people are making investments on our platform in projects that are out there, and so whether that takes, and you can ask yourself this question, whether that takes 5 minutes for your transaction to get confirmed that you invested $100 in a solar project in Idaho, or whether that takes 10 minutes, I don't think that really matters. Is going to make a difference. Same with as you're paid out from those projects in the future. If you get it on a Tuesday, it doesn't really matter whether it came in the morning or the afternoon. So from that perspective, that's one main thing, is we can work with the existing system as it is right now. Second thing is that there is a really big Ethereum developer network that's building and growing, that's bigger than a lot of the other ones that are out there, and so this is all going to change. It's going to continue. We lived through HTML and JavaScript and all the iterations after that on the website, and it's going to be the same type of evolution. So for that perspective, we think there's a big enough developer network where it'll stay. We did look at there's Neo out there, which we think is a little bit too much of a controlled type situation. That we really don't want to do, and then Cardano is great, in theory, but it's not really out there. It's just something that they're working on and hoping that it gets done. Lastly, the other issue is going to be interoperability between blockchains is something that's a technology piece that's being worked on as well. So it may get to the point where it may be okay to be on one network and be able to, blockchain network and be able to have that interconnection. So for that reason, we're in on the Ethereum side.
But in terms of asset-backed cryptos, does Ethereum offer any specific advantages? On Hyperledger, a smart contract is programmed in the Go language. You need to know the Go language. And there's a lot of Go programmers out there. There's actually a lot less Solidity programmers, which is the one of the languages that's used on Ethereum. So Ethereum, the VM understands opcode, which Solidity kind of like compiles into. So I don't know if what the numbers are in terms of the talent that's out there, but from a business point of view, if you're looking at it from a business point of view or a financial point of view, what does Ethereum offer, or what does the Waves chain that you were talking about offer that's specifically advantageous in ABC?
So like I mentioned, Ethereum is just that it has this amazing network effects, and there is less inertia for someone to participate, and less inertia for someone to actually transact and trade these tokens. And at this point in time, that's why I say that even though Ethereum has issues with whatever like scale or what. I'm sure things would fall in place as time goes on. They're developing new standards and all of that, but it's a no-brainer in a way to just stick with Ethereum purely because of the network effects that it offers. And now because we're talking about tokens, we have to also talk about exchanges where they actually get transacted.
I'm gonna come to the exchanges.
Yeah.
A little bit later. So
that's
we're
one
gonna
of the
get to that,
reasons why an Ethereum token would make sense.
Okay, great.
Yeah.
All right, so when it comes to exchanges, but I want to talk about SEC filings. So I know, Michael Scott, you've been working with the filings. You guys have some filings done. I think you guys are not at that phase yet, but when are you guys going to be in the market? I mean, this is a question for both parties. When are you going to be in the market? How are you handling the volatile regulatory environment that exists right now? How are you preparing yourself with that? So maybe we'll start with Scott, and we'll move down. Yeah. Oh, yeah, sure.
Okay, so just to kind of review, or just to kind of explain what we're doing, we have our pre-ICO that's out right now on an SEC registered basis, and so that's just under the Jobs Act. We used one of the regulations crowdfunding rules to get that done. What we're going to put our token out on is under what's called a Regulation A Plus Tier 2 offering as that preferred security. So preferred security token. So from the in terms of the volatility of the environment, we don't really consider that the regulatory environment defining ourselves as a preferred security token is in fact volatile. We find it to be relatively stable, actually very stable, and we're just looking to see what future regulations might do to accommodate the additional features that our token would have in addition to a security. So our strategy is to start with that base and be on safe ground, and then work towards opening up additional functionality from that.
So in our case, we are kind of doing the same thing because we've been working with quite a few of our clients with regards to equity crowdfunding, and we find that there are exemptions that the Jobs Act offers, and we are trying to do the same. Because the first thing is that we are clear that we are a security token, and once you admit to that, then things become easy because then regulation in a way kind of helps you rather than kind of being restrictive. And I think we are looking at a process where we are able to do a Reg D placement for under the Investment Companies Act, which restricts the number of investors to 100, and also do a Reg S for offshore, so that anyone from outside of US can participate in the sale. So this would be in a way we are basically leveraging the existing exemptions offered by the SEC for equity crowdfunding and offshore investments, and kind of building things. And the interesting part is when you do a Reg D, the investors have to hold the token for a year, and you cannot trade it for a year. And I think it's a good thing for us because we being a fund, I mean, in year one, you're not going to see much of returns, and it is logical that it stays that way. But the interesting part is once the period is done, you can start trading these tokens with the general public. And that's where we feel the democratization aspect would come in, and people can get to own pieces of companies that may IPO or go big tomorrow.
One final thing, yeah. So we're also doing a Reg D 506C offering for accredited investors. So because we absolutely agree with what they're saying. So I think we're all very much on the same page here.
So you had something, Michael? So in terms of exchanges, if you wanted to move your token onto an exchange or a coin onto an exchange, that's a bit of a process, and there's a bit of a risk there that they're not really going to take you on unless you're producing. There's certain volumes in terms of trades, and that means for them revenues, right? Why would they take you on? Now, asset-backed cryptos, unless you're dealing with really small assets, micro assets, if you want to call it that, these chairs. If you're dealing with large assets, you're not going to have a lot of volume moving around. So what's the outlook for ABCs in order for them to get into these exchanges that already exist, or is there an opportunity to create an exchange that's specific for that type of trading and marketing? So
it's completely an open field in that regard. exchanges have to really demonstrate governance for themselves in how they decide and choose and decipher between who they're going to list. What the qualifications and criteria would be to be listed is something that is still kind of morphing. I think some exchanges just require you to pay a lot of money, and then you get listed, and that's just the price of doing business. Others may require just would like tokens in exchange for marketing the exchange and the token. So they're actually taking an active role in marketing your listed token to drive more traffic to it. If you're going to build an exchange that's purely feeds to, if you could look at an exchange like equity crowdfunding platforms. There's multiple ones out there. There's from say Start Engine, which is usually regulation CF, which is up to $1.07 million, to WeFunder or other examples of just different crowdfunding platforms. They have different. There's energy funders for and energy, and it provides an opportunity to have access to people that understand that domain, understand and are comfortable with that space. So we see that happening in the equity crowdfunding side, and there's different platforms for different things, for films, et cetera. And there's a really great community of investors there that you can crowdsource funding from. But so that the opportunity exists for people that also are going to feel comfortable with a asset-backed token.
So when you're talking about exchanges and we're talking about tokens that are securities, so once you've declared that a token is a security, it also kind of brings the SEC in, because the SEC is the Securities and Exchange Commission. So for you to list a security on an exchange, that exchange has to be compliant with the SEC. And that was not the case until, say, December, when T0 did their ICO and went live. So we were specifically looking for SEC compliant exchanges, and there are maybe 2 or 3 that are live at this moment.
Who are they?
So there's T0, and there is Templum, which is again New York based. So these are exchanges that are saying that they will not trade utility tokens, but they will only trade tokens that are securities. And the way they're doing it is quite simple. So they're using alternate trading systems that banks have been using for so many years. For instance, let's say if I own a portion of Airbnb, which is still a private company, I can go to these ATS systems and trade my position. Maybe I invested in 2010 when it was still a young company. Now I can actually go and trade it through an alternate trading system. And the SEC actually publishes a list of these ATS systems. So you would get a list every month, and you can see which ones are actually authorized to do these transactions. So these players like T0 and Templum are basically using ATS systems that do these, like, I would say, dark pool and private security trading. They're using these, and they're actually scaling them in a way where you can actually trade like higher volumes. So I had 2 conversations. One was with an ATS system someone who operates the ATS system at JP Morgan. And their ATS system operates in a way where they don't do transactions below, like, let's say 20 million. That's the volume that they're looking for in one transaction. But whereas these guys are basically taking the same system, and they're willing to start trading smaller chunks as well. So there's like more opportunity for retail investors to come in. And the way they're operating is, again, the way they plan to get paid is that they want to charge 1% off of the buyer and 1% off of the seller. And they're going to do just their own due diligence to vet projects to see that, okay, these are not obvious scams and stuff like that, yeah.
So, but 1% is a lot for a large asset, right? So, right.
Yeah, so we're following up on that. We are doing exactly the same thing. It is definitely the case that these alternative trading systems are being developed right now, and actually, the estimate is that over the course of 2018, they'll actually be in place. So, for example, I know if you've done cryptocurrency investing, you may see these tokens that are out there on exchanges, where as a U.S. citizen you can't invest in it, you can't even get to it, or they won't let you be on the exchange to trade in it. All of these SEC compliant, asset-backed tokens are expected to be or will be on alternative trading systems that are available to all U.S. investors and available in the U.S. and also regulated as an exchange. I'm sure we've all heard of those exchanges that had those hack situations, which may or may not have been real hacks, and no one really knows what happened, and money disappears and it comes back, and such as so that all that will kind of disappear with these actual alternative trading systems in place.
And so, broadly speaking, do you think that asset-backed coins are going to become the dominant form of cryptos? So right now, what's most coins are, their asset is a white paper, right? That's the asset back that's
So
backing
true.
that coin, right? So it's not much of an asset there, right? So these true asset-backed coins start to emerge, and you guys are pioneers in that space in some sense. Are the other kinds of tokens just going to disappear? Like, what's going to happen? What are your thoughts on that?
It will shift from the academic phase, of where these white papers came from. And I think it'll go back to basics, turning $1 into $2. Understanding if this company actually has value, if it's acquired real tangible assets. It shouldn't be in competition with transformational technology that people are trying to develop. There'll be a place there, but now there's just a little bit more merit-based. And it's a really a welcome thing, and I think the future is bright. Transformational captures the hearts and minds, and that's a perfect space in crowdfunding, but also can just be done at that late stage. There's very little application today, and understanding about that investment in something that is a transformational technology. So I think, just going back to, okay, I do sell this. This is what it is. You can value this. There's a precedent. There's comps. There's different understood approaches for people to go and invest and understand what the possible return is. And that's really important in this space. In the space right now, a white paper basically has one purpose: to make you say, I give up, I trust these guys because this sounds complex. Or it's just there to sell on Fiverr, because there's a whole other industry around that. So it's just kind of some commentary.
If I just have to comment on this, it would be that right now you have a lot of currencies that don't have a valuation model yet, and it's difficult to value them. I mean, today you could see these skyrocket, but there's no reason behind that, and tomorrow they could drop, and there's still no reason as to why they would or why they wouldn't. And that's where asset-backed tokens can kind of bring some legitimacy to the space. Will they outstrip non-asset-backed tokens? Maybe not, because of transaction volumes and different participant behavior in the ecosystem. But these could be this could be a way to start legitimizing things. Because if I'm thinking about a 401k plan, would I put a lot of these other crypto coins in it, or would I put asset-backed tokens? I mean, at this point, I wouldn't do any because it's still at such a young stage. But if I had to, I would go with asset-backed. So that's kind of the way it's trying to bring in a bit of legitimacy, a bit of method to the madness, I would say.
So you're saying that ABCs are not going to, in the future, outpace just these asset-less tokens? Are you saying they are, or they're not?
I would say
that doesn't work.
I don't think that question is necessary. I think right now it's just technological Darwinism, and you figure it out. What works, and that's what everything is about. We have to go back to the basics of actually saying, you know what, we're not all futurists. We're just figuring out what something is and what the practical value and return on this investment could potentially be. We've deviated very far away from that. And now we're just, again, that was New Year's Eve, and now it's New Year's Day. And it does present an opportunity for smarter institutional investors to come in and say, okay, I can actually sell this idea of an instrument. If I'm in wealth management, I can sell this to this person because he understands something that already exists, like an asset.
All right, I'll take a crack at this. I think there's a strong potential that yes, asset-backed tokens could be substantially larger than all the other cryptocurrencies combined for the following reason. If you just go from the concept that tokenizing real estate, renewable energy, music rights, intellectual property rights, and all the other assets that are out there, I think even just real estate and renewable energy alone is worldwide. There's probably, I think it was close to 200 trillion or more in assets that are owned by all the different people in the world. And if this is a project that's going to essentially democratize capital and decentralize it, through tokenization and such, even if you make a significant dent in that, you don't even have to get anywhere near it. You're still already blowing past the for example, right now the value of all cryptocurrencies on a good day is 700 or 800 billion, on a not so good day is 400 billion, and a lot of that's Bitcoin. But even if those make significant strides over the next few years, and a lot of those technology companies and those technology-based ones like Ethereum, which will definitely, a number of those will definitely have a good opportunity to grow. They're not going to be multi-trillion-dollar companies, all over the place. So I think just from that alone, I think there's potential for, and most likely much larger. Yeah.
Please disagree with your brother.
Well, actually, no, I don't think I can. But no, I just wanted to add very briefly. So I think if we look at the non-asset-backed token universe, I would say probably about 90% will fail. Then that's roughly in line with like typical startup, right? Just same mentality, same metric. But I guess so. I think why is that the case? It's because we have a lot of weak use cases out there. It's kind of like a spray and pray sort of bonanza that's been going on. There are some great ideas. I think that for the non-asset-backed portion, where you're going to see the biggest pickup and biggest relevance and presence, is going to be in globally scalable fintech disruptive technology. So, talking about transactions, global transactions, kind of replacing the way we pay for things anywhere and everywhere in the world. Those are the leaders. I think also that non-asset-backed tokens that are focusing on like the infrastructure of blockchain, for the open blockchain story that we're talking about, that those stories I think are the really solid ones. But yeah, I definitely would say because the vast majority will fail, I think there's probably a greater likelihood that the long-term survivors and winners are going to have some component of being asset-backed.
And regarding KYC and AML, what are your thoughts? What are going to be the requirements here, specifically with ABCs? Yeah.
I think just from a regulatory perspective, KYC is know your customer, AML is anti-money laundering, and one of the issues that people are worried about is a lot of these overseas ICOs that are not registered, they could be in money laundering situations which could end badly. Anything that's SEC registered or compliant automatically requires know your customer and anti-money laundering compliance and checks. So I think that these will all be in that category.
Okay.
It's a pretty surprising space to watch. As running an angel group for a university, the standard when we began was basically a TOS button. You had to go and click the right answers on like 4 different questions, depending on like your net worth, et cetera, to be considered an accredited investor. And that was the easy approach, and also non-verifiable, like so much is on the internet. Now we're entering a space where there's an incredible amount of information that is requested of the person. Some from essentially providing your social security number, et cetera, your returns, to of course taking a photo of yourself with a passport, et cetera. And this is a cat and mouse game because there's such interest to be able to invest in different spaces that, in terms of your jurisdiction of where you are, you might not be able to. So there's always going to be an undercurrent of people trying to go and figure out other ways to go and sidetrack that. It's definitely, it's one of the things that I think is there's so much interest in know your customer, but there's not as much attention put as to like know the entrepreneur. And if you look at any ICO, just please do one thing. Right click on the image of anyone that is there and go to Google search image. When you find out that that awesome blockchain expert and futurist is actually Dorothy from Kansas and has like a book club, it's a kind of a crappy feeling. And you come out feeling like really dirty and understanding that a lot of the undercurrents that are pushing this industry that people get so excited about is, there's not enough due diligence on the companies. And the unfortunate aspect of that is on the day trading aspect of volatility and the value of a token, there's a lot of money to be made with socially engineering things. And this is just the case. So I'd like to see a lot more on the know your entrepreneur, know your founder, are they legitimate? And it can't be from publicly sourced, crowdsourced, or self-input information like LinkedIn.
And I think going back to KYC, so the good part about the KYC process is that it also creates safeguards, because let's say in our case, we are able to make some returns for our investors, and in the case that the Ethereum blockchain fails and no one's mining anymore, I mean, it's not saying it's a probability or a possibility, but it's a possibility. So in that case, I would be happy to know who has this token so that I can actually send the money back to them. And that's where the self-governance component comes in, because doing KYC kind of tells me, okay, this person has bought the token initially, but it's changed hands. And because if it's under the SEC compliant exchanges, every person who purchases this token would have to go through the same process. And everyone's details are captured. And we need to understand that the SEC is there to protect investors and not to stop projects. And I think that's an approach that we are taking, and we feel that having that in place would help us, because it just creates a mechanism where we are able to compensate or pay the investors in any case if things fail.
Okay, great. So I think what I'm going to do now is open up the questions from the audience. If anybody has any specific questions, you had a question, I know. Do you want to ask that question?
Sure. In terms of blockchain, in terms of renewable energy and real estate, on the real estate end, isn't title insurance blockchain? And on the renewable one, how do you substantiate blockchain?
So, I can answer that question. Title isn't blockchain. So, title has a chain of title, but that's not necessarily on the blockchain. The problem with title, the risk with title insurance is you have information that's sitting in city registries about the history of a piece of property. The risk for underwriters is not that, it's what's not there, right? Somebody has a will that they kind of kept in their pocket for 20 years, and they show up and say, hey, actually this property that you just bought is actually mine, right? And that piece of information is not gonna sit in the city registry. So this wholesale copying of the city registry and putting it on the blockchain is actually gonna be not really gonna solve any of the problems that blockchain is looking to solve when it comes to title. But if we securitize a piece of asset, like a piece of property, we securitize it, let's say use a non-fungible token, let's say the ERC-721, which is kind of like this CryptoKitties kind of standard. I've got a token that represents this piece of property, and I've traded this token. That's a chain of title right there that's sitting on the blockchain. We kind of like, it comes out that way, that by moving this token around, there is this title history for that piece of property. So I think we will start to see title on the chain as an unintended consequence of trading asset-backed securities like property. But the other question, you guys, what was the first question that you asked?
How do you relate renewable energy to blockchain in terms of solar and or hydro?
So we're actually solving a really specific problem that we have in our industry, which is that, we for instance, we're working on a 20 megawatt project that's a $40 million project, and everyone and their cousin and uncle is happy to provide funding for that and show up, banks, equity, and such. On the other side of the coin, when we'd like to do, say, a small project on the top of this building, for example, to bring solar there and do some type of long-term type of power purchase agreement, there's like this giant hole in the market where there's just not that ability. And the reason is because it's too hard to do too much due diligence and checking and verification, and it's too hard to get a lot of people to do a lot of small projects and bring them together. For example, if there's 1,000 people with $1,000 and there's a project of 1,000 projects of $1 each, hundreds of those investors may want to invest in one project or others and such. And so essentially our decentralized peer-to-peer platform is specifically to make it so you can be sitting anywhere in the world and you can see any other project in the world. And there's another piece to it, which is it's not just the initial, deciding you want to participate in that, but it's also being able to have that liquidity on the other side, where you say, gee, I don't want to be in this because I want to go do something else, or I need funds. Then you can get out. So that liquidity and that ability to connect, and let people make their own decisions on those are two huge issues which we're solving and we've been experiencing for years in our industry. And that's where we come from on that.
And just one other follow-up there. Additionally, what we're going to be doing is we're going to be facilitating institutional investors, like private equity funds that own renewable energy assets, particularly in the United States. When they've exhausted their tax credit benefits, they frequently want to exit these projects, or will be exiting. And this will add a liquidity premium to that asset and allow them to more efficiently dispose or sell. So that's kind of the other side as well. So it's not just retail investors gaining exposure to renewable energy. It's that, plus it's the opposite direction of institutions selling, and in both directions. So.
Yeah, I'll come back to the go here first.
Yeah, you mentioned disintermediating the private equity role in the process, and I wonder if you could go back to that and flesh that out a bit more.
Sure. Yeah. So when we look at a typical solar development company that, for example, develops a project to notice to proceed status or whatever status of completion, they go to a typical private equity fund. Private equity fund will, buy it, take out the developer, purchase it, and we're done and we move on. So the problem, as my brother was mentioning, was that when you get into what's called the non-utility scale or small utility scale sector, or commercial, industrial, affordable housing, whatever it might be, also where the off-taker or the buyer of the electricity is not what they call credit, so they're sub-investment grade, sub-BAA1, or however you want to define it, then what happens is the ability of a private equity fund to price and purchase that smaller asset, because of the higher due diligence costs that is required in this very high-touch process, as it is now done, as I'm sure many people here know. The issue is that the ability for a developer to monetize that developing smaller projects is limited because the margins are very low. So basically the problem we're solving is we work on large utility scale projects, we work and develop smaller projects. And in the smaller area where the unlevered IRRs are much higher, like into the mid to high teens or 20% sometimes, even on a risk-adjusted basis, depending on how you're looking at it, the issue is that the private equity capital is just not able to pay, or they don't wish to pay, because they're trying to pick off the developer. And so so the disintermediation concept is it's not so much for the utility scale projects, it's for that higher IRR segment, more profitable segment that we're trying to capture, and allowing investment to come directly into those projects. And obviously that's only possible if you use blockchain technology, because you must have things like Internet of Things connectivity, you must have due diligence, combined in that process. And we have a diagram of that we can send to people if they're interested. But
yeah, I would just add that the disintermediation is in part of a market that doesn't exist because it's just too small. And then on the larger one, the disintermediation is essentially being able to connect investors directly with projects. It avoids all those intermediary steps so that they can get better returns. Investors on our platform can get better returns because there are no intermediaries in between.
So from my understanding on these open blockchains, that the ledger is immutable. And the only way to initiate these transactions, the token holders have to have access to their private keys, right? So what are the implications in an asset-backed crypto if a user or a holder of a token loses their private key? Like, how does that affect the asset? How does that affect the other token holders? Like, if I lose my private keys on Bitcoin, whatever, it's like I lost some dollar bills or something. But in this situation, it's a little different, isn't it?
I mean, this is a case where like you have value transferred to those wallets or addresses, and it's just that it has value, but no one has access to it. That's it. But what changes with asset-backed tokens is because you have all these like KYC processes, you can actually identify who the person is, and you can probably mitigate that to an extent. And this is just not possible with like other forms of crypto. Like if someone sends Bitcoin or Ether, then you just can't do it because of the anonymous nature of wallets and them just being that way.
But then what's the use of having a blockchain? Like, isn't that just, then you might as well just have a central server database, right?
Exactly. So the blockchain component here basically comes in at the protocol layer where you have people mining to enforce these smart contracts. So let's say I issue this asset on top of an ERC standard token. So this token is basically going to be mined by people. And I mean, you have these smart contracts being verified and enforced. So for instance, let's say if there's a case where I code in and say there are only going to be 10 million of these tokens. So that's going to be on the ledger, and that's going to stay that way. No one can tamper with that. So that's where the blockchain component comes in, because if that is not there, then I could issue 10 million tokens and then again pump in 10 million tokens into the market, and then it doesn't seem what it is then.
Hi, I just had a quick question about how the KYC works. You indicated that it's required by the SEC law for every transfer to be monitored. Is that through the exchanges? How are you actually KYC tracking these tokens through the secondary markets?
I'm not the expert in that area, but I believe that in the same way, if in order to be part of the exchange essentially, or the alternative trading systems, you're going to have to go through a KYC process there. So anyone who's actually on that to start with, it will have already gone through that.
Hi, so Bitcoin was created to kind of not have all this regulation, all this centralization. Do you think that the SEC will win and all Bitcoin and all blockchain coins will be regulated? How many unregulated exchanges do you think we'll see? Do you think this is a disadvantage to our innovation as a country?
It's a big question, and a lot of people want to know that answer. Let's think about how long it took to take down, say, Pirate Bay, right? A really long time. And it creates, Pirate Bay is, just so everyone understands, like Wares is basically pirated software. And then through BitTorrent, you'd be able to go and do peer-to-peer exchange, and it was a lot of fun. Just imagine it would be. But to speak to that, like, yeah, I think there's going to be a space of where innovation does require to step out of regulation. And that's going to happen in places with jurisdictions that are favorable to that. So you'll see some jurisdictions that are in countries and governments that are kind of positioning themselves to be a place where there's a bit of a sandbox in figuring out new ways that capital formation happens or trading happens, et cetera, et cetera. I think it's going to be a cat and mouse game for a while. There'll be some brand name exchanges where people know what they're getting into. And then there's going to be, the underground, which there always is. But that's also where the most innovative side of things are. So it's hard to answer that question, but I hope that there is more aggressive guidance and also open dialogue between, say, in the United States, with the SEC and companies that are actually trying to do good. And it's not hard to identify companies that are adopting blockchain or engaging in the space if they're actually trying to be transparent.
Also, an argument can be made that if people are losing less money, you know, by not being scammed in ICOs and are putting money into legitimate companies, that would possibly promote innovation. So there is that counterpoint where if we have an orderly market where people are not taking money and just running away because they've got a massive Telegram channel, then, you know, innovation is not going to get hurt. I think this idea that innovation happens in complete Wild West, unfettered, is somewhat true, but not 100% necessarily always true. And I think it remains to be seen where that's going to go.
From what I've seen, I have been reviewing ICOs within the last few months. So from what I've seen, over 90% of the companies that I saw, they don't really need to be on a blockchain. I mean, they say they need to, but a simple website can very well connect directly, you know, a buyer and a seller, whatever. I mean, there's a way to do it without using the blockchain. What is your opinion on this? Because I don't see a reason for most of these companies to be on a blockchain.
Yeah, I think there was an iced tea company that changed their name, and they had no reason to change their name. Yeah, so you.
Yeah, I guess like you can see some parallels to the .com bubble here, where like any website out there had to have a .com, even though it had like no utility or no case to have a .com. But it's that kind of a time where like you want to separate the Amazon from the pets.com, because you don't want to miss out on these like really good projects that actually utilize the technology or utilize this mechanism to raise money and create something of value. But there are so many projects out there that just use the word decentralized, or that use the word blockchain, or they use the word protocol. So you would see a lot of white papers where like if you just do a search, these words will pop up again and again. But in most of them, it just doesn't like, there's no case for them to even be there. Like some of these projects are just apps which you can find on App Store, that's it.
You know, and it's not necessarily a bad thing, but you have to understand also the relationship that if they are doing an ICO, what is that relationship to the parent company? If it's a completely separate entity, you know, it's just a mechanism sometimes to raise capital because it's all the rage. But it also means that it steps out of the governance and the people that supported that original entity as like an equity investor. And so it doesn't necessarily, in some cases, it's a little tricky and scary that they're not under this, that they have a kind of relationship as a consultant to parent company. And that doesn't actually fall within to the value of parent company.
And just to follow up, that is a great question. A lot of people say, well, you know, can't what you're doing just be done with a database? And I think it goes to the central question on the blockchain side, which is, do you want, you know, a decentralized or a centralized situation? And in some cases, while it could be done that way, you may not want it to be done that way. The quickest example would be a lot of the disintermediation plays on blockchain are turning things into peer-to-peer technologies as opposed to a centralized database. Example, you know, there's a group trying to do, I think they're called RideCoin, and their goal is to basically say, hey, let's just get rid of Uber and let you know, drivers and passengers connect directly. In that case, you know, you're getting rid of that extra layer and piece there. So that's one, and another one is it's also the data piece as well of just having that data. For example, in our case, we're putting together, you know, digital identities and digital reputations, so that the people who are actually doing the projects on our platform, there'll be an open ledger as to what their performed differences over time. So that's just a couple examples, but I think there are a lot of examples where it does make sense, but it's a great question to ask.
We'll take two more questions. Pizza's here, and then we'll wrap up. So, yeah, just two more questions.
Yeah, so I have a question about asset-based tokens in general, I guess. So what are your thoughts on, I guess, the potential, I guess, integration or, I guess, competition of the asset-based token technology with things like privacy-based coins, like Monero or Zcash, or things that use like blockchain obfuscation, like Verge, with their Wraith protocol, or things like that? Like, do you think that asset-based tokens can exist in a world where those technologies exist, or will asset-based tokens phase out those technologies because they're untraceable? What do you think?
Well, it's tough to answer, but there can only be so many, say, privacy coins, and adoption of multiple is just going to be like chaos. I don't have too much more input.
I mean, with respect to private coins, it's going to be a case where, I mean, you're talking about two different things with two different applications. Like, private coins are now mostly being used as a medium of transaction, and they are in a way being used as a medium of investment, which, I mean, maybe isn't the best way to use them. But asset-backed tokens would act as a source of investment. So the utility is different. So they're giving you a different way to achieve value than just being able to use them for transactions. So I think that's where the difference is, and I think it would come back to what the person buying into this token is seeking. So are they looking at this as a long-term play, or are they looking at this as a speculative play? Are they looking at it as a way to just do transactions? So it depends on the applications that the person is looking for, and that's why you start picking different tokens and using them accordingly.
Okay, we'll take two more.
Okay. Do you think that having a required KYC identity layer to ABCs conflict with that fundamental idea of peer-to-peer exchange or decentralization, of having to go, for example, through these alternate exchanges that require KYC? And will that limit the scale of, I guess, your token or the market that you can reach?
That's the question that comes across to everyone that is thinking about launching, say, an ICO, is what is the kind of total obtainable market of investors that I can reach? And is that more active in which jurisdiction? Where should I incorporate this company? Who can I access then? So yes, it does limit, and it also provides, but also falls within some regulation and norms that people are used to engaging in. So yeah, it's antithetical in some senses that, like, yeah, it doesn't, it's a step back in total free trade globalization, but also we need to have limits. And I think where the issue is that really limits it is just government philosophy and going back to just different regimes of thought. And until the classes that basically make those decisions within a certain sovereign kind of change their attitude, it's going to be difficult. But the people within, I mean, it's kind of, the genie's already out of the bottle. And I believe, again, people will always find a way.
I mean, it's very possible to build a system on the blockchain that is completely secure and anonymous, even more so than Bitcoin is, and we're only in the first stages of that, such that the SEC can't even track it. It's very much possible to build that, and we are moving in that direction. The question is going to be, if we do build that and that does come out, how is the SEC going to enforce that? The question then becomes, in most individual minds that are investing in tokens, is should I invest this and take the risk of going to jail, right? And I think most Americans are not going to take that risk. There are always going to be that fringe that is going to be willing to do that. So we are going to be willing to give up our privacy to some degree in order to have the opportunity in a safe sandbox to invest. And that has proven to work since the 1930s. A safe environment to be able to invest has generated the kind of returns that we have in the stock market over the past, since the 30s, since the Great Depression. So maybe you're thinking about from a hacker point of view and things like that. There is going to be this constant dark pool and kind of underbelly that's going to exist. I just don't think that it's ever going to be mainstream economics. People are not going to really, and that's going to be true globally.
I just want to say one more thing about that. I had a conversation recently with someone that runs a Chinese exchange, and he was in the U.S. seeking U.S.-based startups that are thinking about launching an ICO and listing them on this Chinese exchange. His logic was very straightforward. He says, in the United States, there are mechanisms in place to protect investors, and the perception of startups from a global standpoint, from outside, is that a U.S.-based startup is a more legitimate animal of entrepreneur and innovation. So that's a good thing that regulation provides, and accountability and transparency. But of course, it has its downsides also.
Just one final note. I mean, as issuers, because we're registering our offer as a security token, by definition, we were fully compliant with all KYC and AML, issues. So just clearly, it's not really an issue for us. It's just, we know anybody who's asking that question, we don't want their money. That's the basic idea.
Okay, guys, thank you so much. Thank you, Bhargav, Timmy, Michael, Scott. You had a question? We got to wrap it up. The pizza's back there. We're going to start the music. You guys enjoy. Thank you so much.